We move on to our fifth session, and our next moderator for this panel is COO Business and International Director, JLL India, and member RICS Global Regulatory Board, Mr. Ramesh Nair, MR, ICS. The first member of this panel is somebody you've already met, Mr. Martin Brule, FRICS President, RICS and Head, International Investment Management, Union Investment Real Estate. The next member of this panel is the CEO, Ascendas India Trust, Mr. Sanjeev Dasgupta, MRICS. Mr. Sanjeev Dasgupta. We'll move on to the next member of the panel. He is the CEO and MD, ASK Investment Managers Private Limited, Mr. Sunil Rohakale. Next member of the panel, Managing Director, Red Fort Capital, Mr. Kalyan Chakraborty, MRICS. Senior Portfolio Manager, Real Estate, HDFC Asset Management Company Limited, Mr. Vipul Rungta, MR, ICS. Joining the panel is the CEO, Aditya Birla Real Estate Fund, Mr. Apurva Mutalia, MR, ICS. The final member of the panel, President, Corporate Lending and Debt Vertical, Ashika Capital Limited, Mr. Vaibhav Jain. I now hand the floor over to Mr. Nair, who will take us through the next 35 to 40 minutes.
Good afternoon, friends. Welcome to this unique, interactive panel discussion titled Pouring In or Trickling In. The topic is quite timely. We have a great set of panelists, some of the most successful fund managers in Indian private equity history, although the history has only been around for the last 10 years. It's been a tough phase for the Indian real estate capital markets. Over the last 1 year, we've seen real estate stocks actually drop by 47% when the overall Nifty went up by 10%. Private equity investments in India had peaked at around 8 billion in 2007. That numbers are down to around 2 billion now. We've seen market caps of large firms like DLF at one time, which used to be 110,000 crores, today at 20,000 crores. Unitech, which used to be 25,000 crores, today at 40,000 crores, which is today at around 2,000 crores. So huge amount of value erosion in the capital markets, the stock market space. Overall lending today in India, various banks and financial institutions have lent more than 2,10,000 crores to the real estate industry, the CRE loans. Mortgage industry stands close to 9 lakh crores today. Sunil, let me start with you. What is happening? Are things changing in India, or is it still the same?
No, I think I think the things are changing for good. My sense is that that whole euphoria of first 10 years till 2008 taught us some few things which are important for all stakeholders. The first thing was, what makes the real estate run? It is not only interest rate or excess liquidity, but also good execution and managing a good mix of cost of capital as well. So, and whoever have not able to do any of these things have carried forward some legacies on the balance sheet. So my sense is that the situation and a good learning of a very good positive environment of 2000 to 2008 taught us a lot of good positive things and a lot of learnings as well. So my sense is that post 9, I think the significant change is everybody is more curious, more going into detailing rather than a macro guy, be it a developer, be it a banker, be it a private equity player. But what has not changed? The costing or the cost of capital to a developer has not changed. And that is one big thing which probably continued to be a problem. What have not changed and which has worsened is the time taken by different authorities to approve the projects. So which probably leads to higher cost of the project, which means the cost has to be passed on to the end customer. That means it affecting the affordability of the end borrower have not changed. What probably have changed is that a lot of domestic capital got raised post 2009. If you see, the large part of the capital came into the market post 8 is mostly domestic in nature, and very few international FDI monies came in till of late. Last 1 year is a little different, and some of the assets like commercial assets probably have got seen a lot of foreign money chasing those assets in the country, and few announcement in last 6 months probably also are giving some different indications altogether. So commercial, which was one of the hyped asset class within the real estate segment, probably have ebbed, bottomed out, and again started looking positive and good. So these are the quick, if I have to just summarize the landscape. But I think as an industry, we are at an inflection point. All the worst is going to be behind. I mean, the stability of income, which was absolutely uncertain till the new government come into picture, which probably less people are worried about their job security or income. Though income is not growing very fast, can be dealt separately, but not having income is a problem. Interest rates have started slowing down, though banks have not passed on all, but I'm sure it is a matter of time. It may be 3 to 6 months, interest rate will come down. Infrastructure, which got stuck, has started improving. So infrastructure, income, and interest rate, these are classic recipes to a successful real estate industry. So my sense is that there is a situation where we are a little nervous, we are negative, we are facing challenges, we are high debt on the balance sheet, but there is a solid ray of hope which is waiting for us. Now, how do we manage this transition of this 6 to 12 months or maybe year plus? Balance sheets will take 3 years, P&L may be taking another year's time. So I think how to deal with the balance sheet issues and how to deal with the P&L issues is where each one of us in this room probably will see the positive side of the real estate.
Martin, earlier today you were mentioning you're one of the largest global funds. You manage like $35 billion and you invest in 36 countries. Unfortunately, India doesn't figure in that 36 countries, and you said you don't see near time India getting into that list. As a big global investor, what's your take on India? What's your perception on why India is missing out on?
Yeah, well, first of all, we like outperforming economies. I mean, we've heard this morning that this is the second fastest growing economy in the world. And if you look at Europe and look at the problems we face in Europe, we actually look for economies which are outperforming. But why do we place most of our foreign investment into places like the United States, which is also outperforming the global economy and certainly Europe? It's because it's a core market, it's highly transparent, and it's got all the ingredients which I think I mentioned this morning, which I don't want to go over too much again. So it's really the question of the maturity and the availability of transparency, of the absence of corruption, standards, and of course access to a professional base which allows us to do the proper due diligence when we invest other people's money. So I wasn't saying it's going to take ages for India to catch up, and one of the reasons I'm also here is to scout and to find out more. But it's certainly going to be a bit of a journey for you all to go together, and if we as RICS can contribute to that, that would be fantastic.
Vipul, do you agree with Sunil that it's at an inflection point?
I think so. I think most important factor is alignment of interest. The first phase probably which came 6-7 years back, there is this strange, it was, I think he also just mentioned, but I kind of don't agree with the statement that if the economy is fast growing, so I should go and invest in fixed assets, because implicit in that statement is an assumption that there's a direct correlation between growth and value of the fixed asset. In the Indian context, or probably anywhere, any economy in the world, what also matters is that I don't go and overprice my buy. That kind of happened in the previous time, the 2006 to 2009, where while the growth was there and the relative growth was there was serious overpricing, because of which there was no alignment of interest. As he mentioned rightly, I think there is now more alignment of interest. people tend to understand, okay, these are the mistakes which were made. So all those things like you mentioned about completion and focus on delivery and blah, 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 all those questions I think are asked more and managed, and those risks are, emphasis more on managing those risks than simply getting into what is the location and what are the Excel sheets, so on and so forth. So that's definitely, there's definitely an inflection point. Key again, I think is, I know, but the domestic fund is fine, but on the international front also, maybe on the commercial, I don't understand that part of the business very well, but what, as an outsider, what I see on that, there is fair amount of capital, more than probably the fair amount of capital waiting for the so-called fixed income and the commercial. So key thing again is alignment of interest. As long as you're able to see that the risk is right, you go ahead and invest.
Sanjeev, Ascendas has been in the country nearly for 20 years now, probably the most successful office developer, international office developer in India, done multiple projects, 4 different cities, successful projects, income producing, very well respected, nearly 400 tenants you managed to get in India. Do you agree with Sunil that things are going to look better and commercial is picking up?
Okay, well, just to get a statistic right, it's 6 cities actually, but including what we do from the private funds. The last 12 months have actually been definitely pretty encouraging for commercial real estate. I think there's a significant pickup in leasing momentum. Even we are seeing in cities like Hyderabad, which went through almost 4 or 5 periods of sorry, a soft rental environment, the rents have actually started hardening. One of the things which has also happened in terms of demand supply is because of the challenges that the sector faced over the last 3-4 years in particular, there's not that much inventory of space of ready office. And that's beginning to therefore translate into a lot of demand for, at least in the top 5 cities, for office. And we are seeing at least in Chennai, in the right micro markets, Hyderabad, and even in pockets of Bangalore, an improvement in the rental profile.
So in 2011, the entire demand for office space in India was around 19 million square feet. The first 6 months of this year has alone seen around 18 million square feet of office demand across. So there's a big bounce back. Apurva, where are we right now in terms of sentiments? Are things looking up?
Yeah, so Ramesh, definitely, like everybody says, that sentiment has definitely become positive. I think, if we were to look at it from 2 parts, at least, and I'm talking largely on the financing side right now, as well as, so from an investor perspective, we're seeing, we're having a lot of talks with a lot of international investors who are definitely looking at India now, including those investors who've, been here in the past between the 2006 to 2010 period, probably didn't have that great an experience. They're once again looking at India. Domestic investors, of course, I mean, last 1.5 years has seen about close to 4,500 crores of money being raised from the Indian markets, which is a, fairly large number. I think the good part, and, while sentiment seems to be moving towards positivity, the good part is that people are becoming slightly more strategic in their thought process now towards Indian real estate, at least on the funding side. Even on the entire 2006 to 2008 period saw money just coming in for Indian real estate. You were not sure, investors didn't care whether it was going into a fixed return strategy, whether it was going into an all equity strategy. But now we see that, people have learned. Fund managers have definitely learned. Investors have definitely learned. So clearly 2 kinds of investors that are also emerging. One that wants money from, returns in the fixed income space. And another one and a probably more sophisticated investor that also understands that there's a lot more money to be made, even doing equity now, given, similar to what Vipul said, with stronger alignment of interest happening now, longer tenure, there is definitely, significant returns that can be made from equity. So we're seeing both kinds of investors. We're also seeing both kinds of fund managers. So I think that's definitely a great sign for the sector.
Vaibhav, your take on the sentiment?
Actually, how I take it is Indians love stories. How spicy you can cook, they love it more. So typically, it's more about sentiments. Real estate is one subject matter wherein even someone who is not related or related. So today you can find a jugglery between two people sitting across. They always want to discuss one sweet topic called real estate. And real estate, as and when they have to discuss, it all drives down. No, it's not really going good. It's going to be better. It's not going to be better. It's going to be bad. So it's all depends on the way it's been presented. I take it to another side today because a lot of developers are here sitting across as an attendees. One of the problem area which I see in terms of any market presence for equity infusion or debt is there is no classification still today as an industry. So real estate, the biggest problem is land. Today, it's the costliest. So today, if someone has to set up a plant or a factory, I don't suppose anyone will be looking into set in middle of a city. They will go in outside in location wherein the land funding does not happen. So it's okay with them because in terms of the total project cost, land is not more than 4 or 5% of the total cost. Whereas if you look into from a project scenario and a real estate, today land has started constituting almost even up to 40 to 50% of the value, which really creates the panic situation. And wherein if the sales are not happening, definitely that creates trouble. But with RERA coming in, sentiments getting improved, black money, I believe, was one bill which has been there coming, which is now setting the chord. So things will going to improve. Definitely, end users were still looking for a lot of units to take in because from so many years, so many time, almost 4 or 5 years has been passed by, but the prices have still not come down. So slowly and gradually, the end users will definitely picking it up. As in the investors are concerned, though people say they were out, but I will say that they were not out exactly, but when they have changed the corner. So instead of investing directly, now they are pouring money in funds, and ultimately funds are investing. So in last 6 months, I believe more than 11,000 crore of investment has happened in real estate from the fund side. So that's my take.
Kalyan, you set up Red Fort. Now you run Rising Straits. What's your take on the overall real estate financing sentiments in the market?
So I'll just pick up from where he said, right? You know, in India, I guess Bollywood runs in our veins for about probably 70 years. Cricket probably runs in our veins for about 150 years. Real estate, if you go back to the days of probably the kings of the Mauryan dynasty, if I stop there, about 3,000 years. So you can't take real estate out of anybody's of our veins here. Everybody is an expert, so everybody has a view. My view personally is, see, if I were to be sitting in 2014, May 16th, I thought real estate problems are solved. You know, sitting what 15 months since the new government has come, I'm not so sure. I'm substantially less sure than I was, let's say, a year ago. Having said that, everything being cyclical, my assumption is in a year from now, things should stabilize. Interest rates are, of course, coming down, but you know, every waking moment, I think it could have been better. I think RBI is being more hawkish than it needs to be. RBI could have already lowered interest rates by at least 75 basis points more than what it has. And many of us tend to forget that post the government coming in, the RBI took up the interest rates by almost 150 basis points before bringing down by 75 basis points. So net in the last 18 months, interest rates are actually up by 75 basis points. That doesn't sound like a great commentary of monetary policy management, but that's the fact. So is there a scope on interest rate improvement? Definitely yes. As far as infrastructure is concerned, yes, we see a lot of promise. This government obviously seems to have its eyes set on the right targets, both with respect to, you know, whether it is energy, a lot of good things happening on the solar space with good, you know, targets being set. Road sector, similarly, lots of good announcements are happening. Housing for all. Yesterday I met, there was a all states meeting in Hudko yesterday, where they're about to announce with some 650 basis points of subvention on mortgage for any loans which are 6 lakhs or less. If that happens, that will be a huge positive. But part of me is also not exactly very happy. It has been 18 months since you wanted to kick off housing for all. It takes forever. You need to move much faster. I think the sector is a bit stuck right now to Sunil's point of there is a balance sheet issue, there is a P&L issue. You can't wish it away. You know, it depends on how exactly do you navigate over the next few months through your problems. If you are successfully able to navigate for the next 12 months, then probably the elements will help you with respect to the growth coming back into the economy, the certainty with respect to your income levels or your growth in income levels, or for that matter, Mr. Raghuram Rajan smiles at a time when you are alive to enjoy the fruits of a lower interest rate. But surviving the short term for the next 12 months in a smart way is critical, which brings you down, if you are a developer, to the same core things which everybody else needs to focus on. Focus on delivery, conserve cash, don't go overboard, and come across as a developer who is honest and sincere. One other thing, as an investor for the last 8 years, I think personally, or 10 years, that I have seen is the regulatory evolution in India has been faster than probably any other revolution. While the market goes its own cycles, the regulatory environment is evolved like mad. So there are things, if you are investor in Noida, you have had these land acquisition issues, NGT issues which came. None of us had underwritten for it. Of course, there is no way to do a crystal ball gazing for that. If you were to look at, let's say, Mumbai, you invest in a project in 2008, you never knew that there is going to be a DCR 91 which will be brought in, 2011 which will be brought in. And if you brought in there, you thought, okay, this will be fine, but there is another DCR which comes in the form of 2034, which then gets scrapped. So you are navigating through a fairly uncertain regulatory environment. And I'm just picking one aspect. You pick up the regulatory aspects with respect to FDI, SEBI, if you are a listed developer, you have other such things happening, takeover controls, promoter level guarantees, so many other things are evolving. On the banking side, things are evolving, how risks are to be underwritten, how provisioning norms are there to be on the banking side. So all of these things create a bunch of different variables for a developer to navigate through. And it is no different for an investor. So I think, the good thing is all of us have got about 10 years of learning. We have all become wiser. The developers are wiser, the investors are wiser, the buyers are wiser. All of that should mean good things in the future.
Sunil, nearly $22 billion have flown in from the real estate PE sector. Around 12 billion is international money and 10 billion is domestic money. But over the last 5-6 years, we've seen most funds only do debt kind of products. Are we seeing pure equity comeback? Have funds started selling that story to your limited partners?
See, I think it's very, financial economics have changed post 8. Till 8, we have seen only a rising market. So in the rising market, you are not really worried about your efficiencies. You're not really worried about inefficiencies. You're not really worried about cost of capital because you are selling ahead of execution. And hence, the economics of those projects and viabilities of those projects was very different, even though projects got delayed because everything was getting re-rated. So there are clearly a land margin and there is a development margin. Both margins were running obnoxiously at a higher pace. And we had an illusion that, oh, real estate is really a fantastic business, where most of the industries got surprised that 2006-07, if you opened up the Forbes magazine, you will have 15 billionaires coming from real estate industry. Same in 2015, not having 3 people mentioned in the Forbes magazine of $1 billion. The reason being, most of the industry operates at an operating margin of, say, for example, 18 to 20%. In some cases, maybe 20-22%. But this industry, if you see the IPO filed in 2006 and 7, we all talked about anyway number between 55 to 65%. So there was a high profitability regime, excess liquidity, lower cost of capital, inefficiencies were carpeted, markets were going up. Was a very different journey altogether. Economy was moving from 3.5% GDP growth to 10% GDP growth. Post 8, generating those returns become simply difficult. Now the fact of the matter is that sales prices are not going up. The sales prices are not going up. There is a slight inflation in the land prices and development margins have evaporated. Development margins have got evaporated because of inefficiency of execution, rising material cost, delay in approvals from government departments, delay in approval of developer deciding the product design itself. So my sense is that developer never relied on the developer margin by itself. So fundamentally, if you don't believe in a development margin, then if the land margin is the margin on which you have to play a private equity, then I think we are fundamentally there is something disconnect in this whole business model. What had happened is that, so whatever monies was poured in as an equity expectations of 25 to 30, was they unjustified? No, they were not unjustified. But in reality, the poor execution, poor sales velocities, and Excel sheets means nothing in reality, correct? Actually got some kind of rethinking in the fund's mind. So my sense is that private equity is the money required at a very early stage, where there are risks associated on the processes, the delays, demand, supply, and so on and so forth. Once you have the land got processed, that means land has got title and approval is in place, then comes into mezzanine financing, which is 18%, 20%. Once your project is launched and started construction and few sales have happened, then comes NBFCs where 15 and 16%. When your project is stabilized and is bankable asset, then comes the bank into picture with 13, 14%. So there is a role for every person in the life cycle of real estate. If we change the character of the money and put all the money in whatever way you want to put it, and every money is coming at the early stage, there will be surprise. So my sense is there is a fear and there is a greed. Private equity guys, along with the developer partner, were always greedy. And then only they can talk about equity returns, which is 25, 30, 35, whatever the percentage it could be debatable. The risk, the other side of the table is a risk. If you want to protection, then you're talking about 13 to 15% return. The stage at which the greed and the fear overlaps with each other, it is the inflection point where you need an exit. Because the developer in his business of development is always going to be long term. He would like to take more time and he would like to revive the asset, and his greed continues to be there. But as a real estate funds, they have their fear, they have their end point, they are limited life, blah, blah, blah. So the fact of the matter is, equity as a character is virtually vanished from the market. And there are few people, and I'm not here to publicize my company or my fund, but the fact of the matter is that we have invested only in equity for last 7 years and continue to invest into equity, but we are not investing into a vanilla product. We are investing into distressed value assets. What is distressed value assets? Too much of land was purchased, too many assets were acquired in a hay time of excess cash flows, excess liquidity. Today do not have patience, do not have a patience to execute, do not want to wait for 5 more years to sell, do not want to construct, would like to hand over this asset which is maybe warm or ready to go to a developer who can bring in delta sales velocity and delta sales price increase. We are only looking at those deals which are, in a true sense, gives us a margin of safety. And hence, so that is the point I'm making. So, and then there are enough people who are willing to wait for some more time, are still looking at NBFC 18% money, and that's where they are confident about it. So there is some change, but my sense is that the more money is on the lending side than the equity side.
Vipul, pure equity coming back?
Yeah, I think pure equity is only coming back because it's probably a better thing to say on the dais than to say debt is coming back, because everybody, as you rightly mentioned, has been putting debt. Whether enough investors are looking at the risk or risk-adjusted return through equity in Indian real estate, I'm not so sure. I think, to put it very crudely, I don't think there are more than 15 to 20 developers on a pan-India basis whom you can take what is called naked equity risk. To put it very crudely, and with all due credit to us fund managers, I'm sorry, I feel kind of sorry for the audience, because the developers sitting there saying, okay, these guys are probably having some money, and so we have to listen to whatever is being thrown at us. But the point is something else. And it's a very simple thing, and I have not been able to answer. Somebody asked me this question 4 or 5 years back, but it applies. So if everything is constant and there are only 2 investors, one who has no understanding of real estate, and that guy's mom has told him, beta, please go and buy a flat. So he takes his finger and whatever project comes in whichever city in India, say 5 years back, whichever project comes in Google Maps, he goes there and buys a flat. And then there is the sophisticated so-called people like us who are trying to do all kinds of risk analysis, equity, debt, mezzanine, blah, 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 blah. And then they come across, if you see the return on a pan-India basis, across projects, unless that project has got into some legal problem, that guy who invested 6-7 years back has made 2x to 3x. And I read some report which JLN only gave, saying that the average fund return has been some 3%. So, So the bottom line is that we can keep debating debt equity and mess and all those things. Bottom line is that how are you making the money? How is that guy who just did single dip testing and he made the money and we did not? In general, because if you're doing investing, you're effectively taking two risks. There's a real estate risk and there is everything else. Developer risk, partner risk, location, blah, blah, blah. I think the fact that he bought that asset, the real estate in general has done okay. What has not done okay is because the fund industry or the banks or every financing industry is essentially partnering the balance sheet side of the developer. It's like the supply side financing. The supply side financing has not yielded the result. And it is not yielded the result because at some level pricing or pricing, both parties are to be blamed. So equity, we can talk, but see, equity is function, as he very rightly mentioned, equity is about pricing. And if I'm buying an asset, like that is why I think at some level, and Sanjay is probably the better person to ask the question, but why are a lot of people looking at commercial ready real estate? In my opinion, they're looking at it because they say, I don't want partner risk. I want a real estate risk. This is a real estate, there is a tenant in it, there is some income coming, so I'm going and buying this, and I'm betting on what he earlier mentioned about the growth of the economy. So there's some correlation. In the kind of stuff which is being done, which is residential and this and that, if you are not able to appraise the risk or relate to the partner, then a lot of other discussion becomes meaningless in my opinion. I'm a structured whichever way I want.
Apurva, main learnings from 2008-9, things which you won't repeat again.
So lots of them. I don't think that 1 minute time limit that you set was enough for them.
Top 2, 3.
No, but I think the key part that all of us now spend time on, and hopefully everybody is doing that, and we're seeing a lot of developers also spend time engaging with us on that, is it's all about the product. It's no longer about selling, just dragging an Excel sheet and selling tremendous amounts of stock at prices which are always going up to endless demand. I think the key learning for all of us is that product is of paramount importance. Partner definitely is. So, that goes without saying. I think for any industry that you talk about, partnering with, the right person is critical for anyone, be it a buyer, be it, an investor, be it, if you're doing a joint venture. But the key part to look at is going for the right product. Looking at the micro market, does the product fit that micro market? Does it fit the kind of buyer profile you're looking to attract? Are you also looking to attract guys who are going to be using it versus guys who have been using a flipping strategy to make money off real estate over the last 4 or 5 years? So I think the key part for all of us, key learning is focus on the product and you'll be all right. And of course, partner and value.
Vaibhav, key learnings from 2008-9?
So I agree to Apurv. One of the key learning is when the markets were really rising, everything was on an increment side. Everything goes well, as what Vipul has also explained. I believe one of the key learning which is there is now people are more into avoiding an execution risk. They really want to place their bet with renowned names, with names they are comfortable with. And product, as what we all discussed here, is key importance. So today, though everybody is talking about that, as in real estate, everywhere, everything moves up. But today, with the concentration risk happening, today location is really becoming a key importance. So I believe right set of executioners along with the right product is the key learning.
Sanjeev, Ascendas has been there for a long time. Many learnings on the commercial side. There are many commercial developers in the audience.
Well, I think to put in 3 words, hang in there. I think, it's just a reflection of the economy as far as the commercial real estate ups and downs are concerned. So, I think when the Chennai asset was built by Ascendas, for example, that was a really difficult time. It was just after the crisis. It took a while to fill that building up. But today, that is, I'm not just saying our asset, but that location, as you're well aware, is one of the most preferred locations in the country for IT offices. I mean, we used to lease those days at about 35. I mean, the Ramanujam rents have now crossed 70 rupees in, 90. 90, okay, which is over 2007 to, so in 8 years or 7 years, the rents have almost doubled. So I think, it's a long-term, I think commercial real estate is definitely a long-term play. I think it does not fit very well in a limited life private fund model. I think if one has to do that, then one should really look at more strata sale kind of commercial real estate, because otherwise it'll just be too challenging to get a meaningful exit.
Martin, in India we've been talking about REITs for the last 15 years, but we still haven't seen anything. It looks like in the next 1 year we could see some action happening. What are your key learnings in terms of how will REITs market impact a country? Like one of the reasons you said you won't come to India till there is REITs because it's quite illiquid without REITs.
It'll certainly make a big change to the Indian market in terms of liquidity, in terms of almost creating a democratic commercial or residential real estate market, because it can bring in all sorts of parts of the middle classes to actually invest indirectly in real estate. It's a great thing. But can I just say a few words of caution there? I mean, it's taken you 15 years to still talk about it. That's, of course, a bit of a worrying thing. So good luck for the next 2 years in implementation with the new government. But I've actually done business in countries where there's a very well-established, mature REIT market. I mean, the US, Mexico, we're actually in partnership with the biggest FIBRA, as they're called, the REITs there. Japan, the J-REITs are very massive. But and also I've seen the REITs industry in Germany fail, funnily enough, because there is such a strong economy of open-ended real estate funds like the one I'm working for. So what I would like to say as a word of caution is when you transition from a non-REIT economy into a REIT real estate market, be careful, because I've seen people miraculously changing their valuations when they have a seed portfolio, bring it into a REIT, for example, and flog it into the public market. You need standards. You need to have discipline as well. You need to have regulation in place, because if one REIT goes belly up with a lot of private money in it, it could destroy the confidence in that REIT market overnight. And then, of course, the whole thing is back again 15 years. So I think caution, standards, careful valuation, and ethics, again, when you actually have a seed portfolio going public, is very important.
Sanjeev, you wanted to add?
Yeah, I just wanted to add that actually the point which Martin touched on, governance is a really, really critical issue for REITs, far more so than in a listed or a private developer space, primarily because the dividend policy, which is primarily one of the reasons why investors buy into REITs, is controlled largely by the fund manager and, of course, the legislative environment. So the reason why Singapore has really, in Asia, been by far the outlier, because if the Hong Kong market cap of real estate entities is actually bigger than Singapore, but the REIT universe in Singapore has been much more successful because of exactly the same issue. Which assets does a developer put into a REIT? At what valuation does he put them into the REIT? Does it leave enough upside for the investors in the REIT? Will they make any money? And even in a very, I keep giving the example of Hong Kong because it's the largest stock market in Asia, largely at least, and one of the most efficient ones. They have struggled with REITs. It's much more profitable to invest in a listed company, go and invest in, let's say, Chung Kong Holdings, than it is to invest in the Chung Kong REIT for precisely the same concerns.
Kalyan, with overall sentiments and the fundamentals looking a little weak, will debt providers like you will you look at giving longer tenures? Yesterday I was with a fund who was talking of 2-year moratorium for both interest and principal. Will these kind of products start coming in given the stress levels in the market currently?
Firstly, we are not exactly a debt provider, we are capital providers. So you can switch to what you want to make with capital. Sometimes you get the debt as a flow, sometimes equity as a flow, depending on the risk that comes across. Having said that, I think it's a little counterintuitive to say that the market is not exactly behaving the way you want it to behave, and hence let's put some extra risk at play and hope that it goes in your favor. That's almost sounding like punting. In the current situation, I would avoid that. You know, be very careful of where you are putting your foot into. Don't allow your optimism to engulf you to such an extent that you forget reality. So the reality is what it is. You can't change it. But as long as you keep your eyes and ears open, hopefully you will do the right thing. I, for one, these markets am extremely careful.
I'll just, we need to wrap up. I'll just ask you a few rapid fire questions, just one word answers, increase, decrease, or the same. Commercial rental market, Sanjeev, increase, decrease, or please answer for the entire country.
Increase.
Martin, Martin is maybe a wrong person to ask, but where do you see the commercial rentals going?
Given where growth is, population growth, urbanization, it's going to increase.
Sunil?
Upward bias.
Kalyan?
I think CBD, SBD is upward, peripheral and downward.
Vipul? Same, upward.
Increase.
Residential sale prices in India?
Soft.
Down. Mart?
Low-income housing, affordable housing, that's the market you should target on.
Sunil?
Residential prices will have time correction.
Kalyan?
Yeah, I guess some correction in the short term, otherwise stable.
Let's look at 1 year.
1 year I will see some correction.
Vipul?
I think it will be soft. The prices will soften, but mid-income, low-income, the velocity will go up.
Up.
The prices will stay static.
Bible?
Yield will be stable.
Stable. Global fund flow into India, Sanjeev, going up, down, or same next 12 months?
Aggregate going up.
Going up.
It's going to increase.
Sunil?
Yeah, it is going to be upward.
Kalyan?
Yeah, I think it will go up.
Vipul?
Should flow in.
Go up.
A lot of it.
Bible? Interest rates next 12 months, Sanjeev? Going down? Mart?
No idea.
At least 50 to 75 bips down.
I used to enter this format at school, you know, 2 points, 2 points, 2 points. I said I will answer.
They don't give you much time.
I think interest rates should go down.
Go down. How much do you expect?
Dip test, I don't know.
I think they'll marginally go down if at all.
Marginally. Why?
Yeah, marginally go down.
Top 2 cities, Sanjeev, for India next 1 year?
Bangalore and Mumbai.
Bangalore, Mumbai. Mart?
Yeah, I'd agree. It's the high tech and the financial markets which will thrive.
Sunil?
I have not 2 people, but 3 people. Bangalore, Pune, and Chennai.
I think commercial, I would say Bangalore and Hyderabad. Residential, I would still bet on Bombay and Bangalore.
As a fund?
As a fund, I think outskirts of Bombay.
Bombay, Delhi, okay. Bombay, Delhi.
Mumbai and Bangalore. And for commercial, I bet on Hyderabad as well.
One asset class you'll pick for the next 1 year? Out of office, retail, residential, hotel, mixed use?
Office.
Office.
Grade A office.
Grade A office.
Mid-income housing.
I guess it's a combination of commercial, grade A, and a little bit of housing, mid-price.
I would kind of say mid-income housing, that's what I kind of do, but I think one big thing will be industrial parks. Manufacturing industry. I'll stick to high price housing.
Affordable.
Affordable housing.
Great. So with that, we don't have time for the audience Q&A. You could always connect with the panelists post the session. Some key takeaways. Sunil started saying the industry is changing for the good. Execution makes real estate run. Commercial markets, office real estate market making a comeback. India is at an inflection point. Sunil mentioned that. Job security is definitely driving demand. We are not going through that phase of 2009 where we were all worried about our jobs. Balance sheets fixing will take around 3 years. P&Ls will take around a year to fix. Maturity, transparency, corruption still still a big challenge, is what Martin felt. Vipul felt more alignment of interest between the funders and developers. Last 12 months has been quite encouraging for commercial. Even cities like Hyderabad picking up, Sanjeev mentioned that. Sentiments are definitely positive. Apurva mentioned that. International investors looking more seriously at India. 2007-8 investors who came in at that time are again coming back into the market. Investors have become more strategic, more equity coming in. Vaibhav mentioned that close to 11,000 crores have been invested by various funds in the last 6 months. Kalyan felt it's going to take at least a year to stabilize. Interest rates improvement is required. Big housing announcements made by the government is helping. The interest subvention, if well rolled out by the government, which was just announced recently, that will help affordable housing. The panelists advised the developers to conserve cash, don't go and overspend. Funds can't be crystal ball glazers. Everyone has become smarter. So from 2009, in rising market, we typically forget about efficiencies. That was a warning from Sunal's side. If things start looking to improve, don't forget about efficiencies. Operating margins in our industry will have to stabilize at that 18-20%. So gone are those days of 30-40%. Developers can't just rely on land margins. A lesson for many developers in this room. Excel sheets mean nothing in reality. This is a good point. Stage at where greed and fear overlap is the time for exit for the funds. That's a good thumb rule. Pure equity coming back, because debt market is crowded. People was honest enough to admit that. But people also mentioned that maybe less than 20-30 developers actually qualify for pure equity, naked equity risk. Common be the decisions. There are some many markets where a common man made much better investments than the sophisticated PE funds. Commercial real estate again has no partner risk. That's again driving international names like Ascendas into the market. Partnership worthiness is the most important factor today, what funds are looking at, followed by execution capability. Commercial leasing, key lesson learned, Sanjeev mentioned, was just hang in there and you will make money. REITs will bring in a lot of global capital. Martin mentioned that. Governance needs to be fixed. Sanjeev mentioned that before the REIT markets open up. And funds are not punters. They're sophisticated risk advisors. Overall, on the panelists felt commercial rentals across the country will pick up. Unanimous residential prices across the country, the panelists felt will correct. Global fund flows will increase in the next 1 year. Interest rates, everyone felt is going to come down. Top two cities which came up was Bangalore and Mumbai. In terms of asset classes, it was offices and affordable housing. And overall, everyone felt pure equity is making a comeback. With that, we come to the end of this panel. I hope the audience enjoyed it as much as I did moderating this panel. I look forward to further interactions.
Thank you very much, Mr. Nair, for moderating that panel, and to the rest of you gentlemen. May I request Mr. Brule to please do the honors and present mementos to all our panelists, beginning, of course, with our moderator, Mr. Ramesh Nair. Mr. Sanjeev Dasgupta. Mr. Sunil Rohakale. Mr. Kalyan Chakraborty. Mr. Vipul Rungta. Mr. Apurva Muthalia. And Mr. Vaibhav Jain. May I request Mr. Nair to please present a memento to Mr. Martin Brule. Thank you very much, gentlemen, for sharing your thoughts and views with us. Could we have you all stand for a group photograph? Thank you very much.